So let's discuss global markets a little more. Joining us now is John Praveen, the Chief Strategist at Prudential International, based out of the United States, directly manages $5 billion worth of assets. And Ajay, he's busy attending a conference these days, a high-profile conference.
That's correct, Antara. John is currently visiting India, in fact Mumbai, to the part of a Cafe Mutual conference right here in Mumbai, which we would be covering all throughout the day tomorrow. So here he is to share his worldview on the investing environment and where does India fit in that. John, good evening and thanks so much joining us on ET Now. Right now in the global markets, on the one hand, trillions of dollars are parked in safe haven assets, perceived safe havens, some of them in fact yielding negative returns or yields. And on the other hand, we are looking at global markets like US, several emerging markets like our own, heading to record highs. How do you analyze this conundrum in the global investing environment?
I think what has happened is that investors have not had too much of faith in the bull market or in the rising equities. They've always been worried about the next problem. So that if you look at this year, the markets have actually been very resilient despite all of the problems that we have had. We started off the year markets down close to 10 to 15% because of China concerns, because of oil collapse. Then we had markets recovered after that. Then in the middle of the year, we had Brexit worry, Brexit anxiety, and that caused markets to have a big correction. But then we have recovered. So we have been investors have been facing a lot of anxieties and worries, but markets have rebounded. And now we are in the phase of on Fed and BOJ watch. Markets are concerned about Fed rate hike and what the BOJ is going to do, and that is causing a lot of volatility. But if you abstract from the volatility and look at some of the fundamentals, they remain positive, and that should probably help markets to rise.
John, you just talked about all the anxiety that investors around the world are facing. How anxious should we be in India about that impending rate hike by the US Federal Reserve? You've also got the crucial Japanese central bank meet also slated for this week. How nervous should the Indian investors be? And I also wanted to get your views on, if you think the rate hike doesn't happen this week in the United States, what are the chances of one happening in December?
I think that the rate hike in the US will probably come at some point. I don't expect that the Fed is going to raise rates this week. They are meeting tomorrow and day after. I think that they will probably remain on hold. But then it is probably a rate hike in December. And then after that, they will probably be on hold to see how things pan out. But over the next year or so, the Fed is probably going to raise rates very gradually. But the way I look at it, it is not a rate hike, but a rate normalization. Because the rates that we have now, the close to zero rates, are artificial. They are rates that were set up during the time of the financial crisis. We are way past the financial crisis. The US economy does not need such low interest rates. So if the Fed is going to be normalizing interest rates, markets will probably have some kind of a negative reaction initially, but
Okay, so you are not expecting a rate hike this week. You think perhaps in December is when we're going to see it. You're calling it rate normalization. John Praveen, you at Prudential International, personally responsible for managing about $5 billion of assets worldwide. So I want to get your perspective on what's the structural case for Indian equities over the next 3 to 5 years. Like I said, you're a big FII. How are you analyzing Indian markets? How do they compare versus the other emerging market economies?
I think that first you have to compare the emerging markets as a whole with the developed markets. And there you can make the case that emerging markets, they have been very volatile. The last couple of years they have underperformed. But I think that we are going to be back to the situation where emerging markets will probably have a good run. Because many of the factors that are supporting, that have helped the developed markets to have a above average returns or a bull market for the last several years, they may not be there in the future, in the sense that that we may not get any more rate cuts. We might actually see rate increases by the Fed. And growth is also probably downshifting. So developed markets are probably going to underperform emerging markets. You can make the case for emerging markets first, and then you can make the case for India, because within emerging markets, India has a pretty good profile, a very, very good outlook, both in terms about higher growth rates compared to the developed markets. So if you look at developed markets, if the growth rates are, the 2 to 2.5%, growth rates in India are more likely to be in the 8 to 10%. Profitability is likely to be higher. And then you have a lot of structural reforms, a lot of things that are going on, very, very positive demographic factors in the case of India. All of that should be positive for India within emerging markets.
John, talk to us about FII flows. You represent the FII community here in India, and we've been observing that the flows have been very strong towards emerging markets, and India also have been a beneficiary of that past couple of weeks and months. Do you think that this momentum would sustain or continue? Because here many people fear that probably this flow can actually stall. And by when, in your view, India start getting dedicated money? Because up till now we've only been getting ETF money. Where exactly does that actually start happening going forward, in your view?
Yes, the fund flows are never going to be in a straight line. They will probably be ups and downs. But if you're looking at the broad trend, so the trend itself is going to be upwards, because there have been some studies done by other global investment banks, which have indicated that the share of GDP of the emerging markets and India in global GDP is going to rise, and the share of market cap for emerging markets and for India is going to rise, which means that that fund flows will continue to increase. It's not going to be in a straight line. There will be times when other emerging markets will probably get a bigger share. For example, last year a country like Brazil and a country like Russia, they had a lot of problems. This year, many of the problems in Brazil are being resolved. So they are attracting a lot of foreign capital. Russia is attracting foreign capital because stabilization in oil prices and things of that kind. So maybe some of the flows that India was attracting maybe are going to some of the other countries, but the trend itself is going to be up. Now, some of the on the political side, the passage of the GST is seen as very, very positive. It is supposed to. We expect that will probably help India's GDP to rise, and many of some of the sectors that are probably going to benefit from changing over the GST and all of that, they may probably benefit. So you're probably going to see an increase in flow as a trend, but with the volatility within that trend.
Right. John, let's talk about your own firm. The team in your own team manages about $5 billion globally in various markets. At the firm level, the number is much larger at $75 billion. What's your own stance towards India right now? And going forward, what factors will actually move the needle on flows further? How much can you raise your exposure into India? And what would that factors be which will make you do that?
Yes. So my own team, we've managed several global and regional funds, an Asia fund, an emerging market fund, and in them we have been overweight, both in the Asia fund as well as in the emerging markets fund. We have been overweight India, and we expect that will probably continue. We might probably increase the overweight if we see that India's growth is going to pick up. We might probably see some more, if we see more rate cuts from the RBI, if we see that there is an increased consumer demand from the rural sector because of the good monsoons, or a good increase in demand from the urban sector because of the pay commission recommendations, and also if we see some improvement in the industrial sector which has struggled. So if we see some of those trends, we will probably increase our overweight. We are already overweight. So we will probably increase it over a period of time, both in our Asia fund and in our emerging market fund of funds.
So Prudential International already overweight on India, likely to increase allocation to the country as well. Thanks a lot, John Praveen, for joining us here on ET Now. John Praveen in India, currently attending a conference, a Cafe Mutual conference in Mumbai. We look forward to catching up with you over the next few days.
Thank you very much. A pleasure being on your show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.